Welcome to ACC 101, Fundamentals of Financial Accounting. My name is Abdulaziz Aidejlawal, and today we'll explore the definition and purpose of financial accounting. Financial accounting is more than just numbers. It's a structured system that tracks financial activities, ensures compliance, and supports business decision-making. Without it, businesses will struggle to measure economic performance, attract investors, and maintain stability. By the end of this lecture, you will clearly understand what financial accounting is, why businesses rely on it, and how it contributes to financial success. Without further ado, let's start with an introduction to financial accounting. Financial accounting serves three essential functions in businesses. 1. It tracks financial performance. Businesses monitor revenue, expenses, and profitability over time. 2. It ensures regulatory compliance. Companies follow strict accounting standards, ensuring tax and legal obligations are met. 3. Supports decision-making. Reliable and financial reports allow stakeholders to make informed investment and management choices. Without structured financial accounting, companies face mismanagement, financial instability, and difficulty securing investor trust. Now that we understand its significance, let's outline our learning objectives. By the end of this course, you will all be able to define financial accounting and explain its role in business, understand why financial accounting is necessary for financial stability and regulatory compliance, recognize its importance in decision-making, budgeting, and investor relations. Now let's dive deeper into the actual definition of financial accounting. Financial accounting is the structured process of recording, summarizing, and reporting financial transactions within a business. Its purpose is to ensure that companies maintain accurate financial records that reflect business activities, provide clear and transparent financial reports for investors and regulators, comply with accounting standards, which is the IFRS and the GAAP, to ensure consistent reporting. A company's financial health depends on the maintaining of well-documented and structured accounting practices. Now, let's explore its key features. Financial accounting has four distinct features. You have the historical recording. Transactions from past records are accurately documented, ensuring accountability. We have the standardized methods. Businesses follow recognized frameworks like IFRS and GAAP for consistency. We have the external focus. Financial data is primarily used for investors, creditors, and regulatory bodies. Then we have the objective and verifiable, which is the financial statements must be based on real transactions to maintain accuracy. These features ensure that businesses present their financial data transparently and reliably. Now let's examine the types of financial reports companies use. Companies rely on three major financial statements to track business performance. We have the balance sheet, which displays a snapshot of assets, liabilities, and shareholder equity at a specific time. We have the income statement, which summarizes the revenue, expenses, and net profit over a set reporting period. And we have the cash flow statement, which tracks how cash moves in and out of business, showing liquidity levels. These reports allow businesses to access financial health and make informed decisions. Without further ado, let's discuss the objectives of the financial accounting. The goals of financial accounting extend beyond record keeping. They serve to ensure accuracy and transparency. Businesses must provide reliable financial information to stakeholders. 2. They will help companies comply with regulations, ensuring alignment with tax, corporate, and financial laws. 3. They provide essential data decisions. Managers rely on financial statements for strategy planning. 4. They enable investors to evaluate profitability and risk. Investors use financial reports to assess whether a company is worth funding. Understanding these objectives help businesses maintain credibility, compliance, and financial stability. Now let's explore its broader impact on business success. Financial accounting plays a crucial role in helping business grow and succeed. 1. They track business performance. Companies measure profits, losses, and operational efficiencies. It supports budgeting and planning, ensures resources are allocated effectively for long-term growth. 3. It prevents financial fraud and mismanagement. Transparent reporting keeps companies accountable. 4. Enhances investor and lender confidence. Reliable financial statements build trust and attract funding. 5. It ensures compliance with tax and legal regulations. They help businesses avoid penalties and maintain credibility. You see, financial accounting is an integral part of business strategy and financial control. Let's look at how financial accounting influences decision making. Financial accounting guides decision making at all levels of an organization. 1. They guide investors. Investors analyze financial statements to assess business viability before investing. 2. They guide banks. Evaluate financial health before approving loans or credit lines. 3. Managers. Managers use financial data to shape strategic planning and operational growth. 4. We have the regulators. They verify financial records to ensure companies adhere to tax and compliance laws. You see, financial accounting ensures businesses can make informed, data-driven financial decisions. Let's take a real-world example to see how financial accounting impacts a business. Let's look at a practical example to understand the real impact of financial accounting. Imagine two companies. One follows the structured financial accounting, while the other lacks proper financial tracking. Let's compare how their financial practices influence their success. Company A uses structured accounting principles to maintain financial accuracy. They also track transactions efficiently with digital accounting software. They go on to prepare financial reports regularly to improve investor confidence. While on the other hand, Company B lacks detailed financial records, leading to financial mismanagement. They face financial instability due to poor expense tracking. They struggle to attract investors due to their unreliable financial statement. This case study highlights how businesses that prioritize proper financial accounting perform better attract investors, and maintain long-term stability. Now, let's summarize the key takeaways. Here is a summary of today's lectures. Financial accounting ensures accuracy, transparency, and compliance in financial records. Businesses that follow strong financial accounting practice greater stability. Investors, banks, and managers rely on financial reports to assess business performance. Maintaining proper financial records help prevent fraud and support sustainability growth. With these key takeaways in mind, let's wrap up with our final thoughts. Throughout this lecture, we have explored the definition and purpose of financial accounting, understanding how it supports transparency, compliance, and strategic decision-making in business. Financial accounting is the foundation of financial stability. It enables businesses to track their financial health, make informed decisions, and maintain credibility with investors and regulators. Companies rely on structured financial records for investment confidence, regulatory compliance, and long-term planning. Investors, banks, and managers depend on financial reports to assess profitability and financial stability. Maintaining accurate financial records helps businesses prevent fraud, avoid risk, and ensure financial sustainability and growth. Financial accounting is not just numbers, it's the backbone of financial stability and business success. Thank you for being part of this lecture on financial accounting. I appreciate your time and participation. Keep learning, keep growing, and remember, financial accounting is the key to business success. See you next time. Thank you.